What's up, everybody? Michael Silva here. That S&P 500, well, it remains sleeping at the wheel. Maybe it'll wake up a little bit come Friday on OPEX, a big OPEX taking place. And then you add in some sugar, spice everything nice with Jerome Powell. We may get some movement in the market. But don't let it fool you. There are assets that are moving right now that typically have a strong correlation with the S&P 500. And we're going to get into that today. But we're going to start off talking about earnings. Yay! So this week of earnings, there's going to be a lot of retail, and these are really going to give us good insight to how is the consumer doing. So for example, today we had Home Depot coming up before the open on Wednesday, which is tomorrow. We got Target, we have TJX, and we also have Walmart here, just to name a few. Now, Home Depot came out and, well, it did not look good. Sales fell 4% over the last year, so revenues were down, I believe, the most, and I believe I heard 20 years. So a huge decline there, which is not too healthy. What did HD do, though? Well, it fell 2%. So nothing crazy, but it was down significantly more, breaking from this consolidation. Now, yes, the S&P 500, we're looking at the SPOOS, the ES, right? Still pinned between 4,200 and 4,100. And I'll be honest with you, I'm going to tell you kind of what it is to look for, that I'm looking for to be more bullish and go long, because we're pretty much on the dance floor right now in either direction, or what I'm going to be doing to really just back off and let price action do its thing before going and doing anything crazy. But yeah, price is coiling up here. We know that, and a move most likely will be here in the near future. We'll see. Now, S&P 500 today on the 15-minute time frame, we broke the daily expected move into the close. So early on in the open, we came down and we just about touched it. Then we started rising up to the week-to-date anchored VWAP, but we couldn't hold that level, and it held as resistance. We kind of wedged here, and then we really broke down towards the end of the day, opening the door, opening the floodgates to head lower to fill this gap, to potentially hit tomorrow's daily expected move, which I'll share, or even potentially the lower weekly. But what it is that I'm looking for to be potentially bullish, I'll show you this on the daily time frame. So yesterday we talked about the quarter-to-date anchored VWAP, right? So now, as price is sitting here, it tells us that the average person, based off of volume, is now under water on the quarter, okay? So what I would like to see to feel a little bit more bullish is obviously price to get back above that, to go potentially reach out for this prior high or the year-to-date high for the S&P 500. I know there's a lot of compression taking place here. We'll talk about that momentarily, potential topping pattern, but you don't want to let this rule you out, because if price starts getting back above the quarter-to-date and it can hold it, that right there opens the door to go higher. As it stands now, what do we got to do? Well, we got to be cautious. Well, let's take a look at the 15-minute time frame and look at the new daily expected move going into tomorrow. It's quite wide, right? So 407.42 to the downside, 413 to the upside. We're below the week to date, we're below the month to date, and we're below the 5-period moving average. So what does this mean? Well, it means that the bears have the control. However, I want to preface this. We're sideways, right? So how strong are the bears right now? They're not that strong. How strong are the bulls right now? The bulls aren't that strong. So to feel more confident, that's why I say I want to get back above the quarter-to-date anchored VWAP, and I would like to see price obviously get back above some of these levels too as well. Till then, if it cannot and it holds as resistance, the door remains open to head lower. And if you take a look at the heat map today, really everything got destroyed in the market. It was a pretty brutal day. However, you can notice some green on the screen, and those happen to be tech names, right? The big mega cap stocks are continuing to hold up the market while everything else has been selling underneath the surface. And this is presenting an opportunity, even more of a coin flip, as we've been talking about. This market's been going sideways. If I look at something like the zones, what you'll see here is you're starting to see things light up that is green, meaning that they're coming to the lower end of their zone. And you could typically get bounces in products when they reach these lower areas. So for example, we'll just go down the list. The dollar is reaching up to the higher end, and we know that when the dollar starts moving up, it's typically bad for equity markets. But when it reaches up here and then it starts heading down, that could be good for various assets, including the equity markets. You can see HYG, high yield, is also towards the lower end of its zone. So you have the dollar up, you have high yield down, and you really have the S&P 500 stuck right in the middle of the range. And then also the Qs. You can see here we're more towards the top, and I can show you that right here by looking at the S&P 100 zone level. So you can see stuff like Google and Amazon coming to its higher end here. So the mega caps have been moving up higher, which means potentially they may need to just take a little bit of a breather. You can see actually Microsoft, this hasn't updated, so it's actually landed in the middle of the range according to yesterday's data. However, if you take a look at where it closed and where the high is, we're not too far off. So we have 1.7% upside versus about almost 4% downside there. Now, we talked about a couple assets over here, including the dollar and HYG, and these are very critical components to watch. We talked about HYG yesterday, so I just want to touch on that again. And I was talking about the divergences. You know, it's smart money here, dumb money down here, but I drew out the divergences manually to demonstrate what it actually looks like on this 60-minute time frame. So for example, smart money over here, right, it put in lower highs, while dumb money was putting in higher highs. So smart money was telling us, hey, smart people are selling right here, dumb money's going up, so we might sell off. Well, we sold off. Okay, well, let's take a look right here. Smart money was putting in a higher high, dumb money was rather flat, right? So matching lows. Well, this gave us some insight to a potential move higher. And then we have a bigger divergence. Let me fix that. Yakaroonies. You can see a high, a high, a higher high in dumb money, where we had a low and a lower, sorry, a high and a lower high, and that gave us insight to potentially that drop off. You can see the same thing right here on the bullish divergence, where smart money was putting in a higher high, dumb money was putting in a lower high. So this is where this capitulation move was to the lower end of the range, and you know the market's all freaking out. Oh gosh, we're gonna crash. But the smart money was like, no, it puts in a higher high, and then we saw this massive rally there. Well, I'm calling this out because if you take a look here, well, look what's breaking out of its range right now, and that is HYG. So we've been in this tight consolidation, just like the S&P 500, and this is what I mean by S&P 500 is kind of asleep at the wheel right now, while you're getting things like high yield starting to sell off. But that's not it. You also have the S&P 500 down here, the dollar here, and it's also breaking out of its range as we talk. Okay, now this doesn't mean that it's going to be going higher. It could pull in. Remember, it's reaching its higher end of the zone right now, so it might back off, and that could potentially help the S&P 500, so you got to be prepared for that. But this has been moving, and this has been asleep at the wheel. And if we look at all three of them together, where you have the dollar, high yield, and the S&P 500, you can visually see that, hey, the dollar is trying to come out of its base, right, its range. The high yield is breaking down from its range, and then the S&P 500 is still asleep right there at the wheel. Now, when high yield goes down like this, that's not typically a great sign for, well, S&P 500 or even the Qs for that matter. And when the dollar moves up, well, it's not typically great also for the S&P 500, because we've pointed out countless times as the dollar goes down, the S&P 500 can go up. But when the dollar goes up, well, the S&P 500 could go down, okay? So that's some interesting stuff, some intermarket stuff that I'm paying attention to. But remember, we talked that at the end of the week, we have Powell and we have a big OPEX, but that's not the only OPEX we have. We have Wednesday tomorrow, that's VIX option standard expiration. And then we have the last day to trade expiring standard AM on Thursday. And then we have the big OPEX on Friday with Powell. So it's going to be, like I said, sugar, spice, everything nice. Buckle up, because it could be just very volatile overall. And then let's pair that with what we talked about yesterday on the NASDAQ composite. So we talked about it was yesterday had the lowest trading volume for the year. Well, today we broke that yearly record of having even lower trading volume. So this tells me price is contracting very tight, meaning that expansion is around the corner. Let me be very clear here for the people that just don't get this. When volatility contracts, it can expand, right? That's a simple it's a basic principle of technical analysis. Things move between contraction and expansion. Now, understand when I say volatility can pick up, that does not necessarily mean stock market go down, okay? It could also explode to the upside. Remember, I'm just pointing out here as price is contracting. Yes, it's in a bearish structure. However, if you just look like this, and you can see price was also contracting right here, and we moved out of this pivot, okay? And things are contracting. We haven't really seen supportive volume of this breakout, meaning that if we do get a distribution day and it heads down lower, this could be itself a bull trap, which is what we've been talking about. Now, also, if you take a look down here at the NASDAQ advanced decline line, this is actually very wild. Okay, there's typically a strong correlation. Advances, declines go up, boom, boom, the market goes up. But this thing has been just going up, and the advanced decline cumulative line has literally, it's flat as a pancake at yearly lows. Okay, so that just tells us we have a lot of poor breath overall in the NASDAQ composite as we keep continuing to head down. Now, this could be a positive thing and a negative thing, the way that you look at it, right? So we broke out of this. The main stocks that held us up were far and few between. The big tech stocks really helped drive it, and we saw some movement in the semiconductors. However, there's a lot of underlying equities that have been getting beaten up, and we pointed that out here on the zones that, yeah, we have a lot of stuff getting beat up, but now it's reaching out to the lower end of its zone, which means if they start bouncing and perhaps the big tech can just remain flat or, you know, potentially come in, we still have the potential to go higher in these markets. And that's why I am watching overall that quarter to date anchored VWAP, right? Because I do not want to miss a run up to 418.31 or, you know, to reclaim this prior yearly high. But also, I don't want to be a part of the market long if we're going to come down and reconnect with a year-to-date anchored VWAP. If you're wondering what the other lines are, this was where the market opened up, the S&P 500, the spiders, and then this was the low of the year. The low of the year was actually on day one of the trading year, and a couple other things that I want to share with you. The NASDAQ 100. I like to look at the percent of stocks above the 50-day, percent of stocks above the 200-day moving average. I just want to show you another reason why I can see some poor breath. The market is drifting higher, but you can see the percent of stocks above the 50-day, well, those have been declining. The percent above the 200-day, well, those have been declining there too as well. And we've seen things like this, well, leading into 2022, the bear market, right? We saw higher movement in the price action, which because it was held up by a few names, but we saw, you know, smaller amount of stocks above the 50-day, and we saw a smaller amount of stocks right here above the 200-day. And on the flip side to that, remember when the market was down here in October and then had literally just before 2023, we had a new closing low. Well, what were stocks telling us? Well, we had more stocks actually finding strength, building above the 50-day moving average and over here above the 200-day moving average, giving us a positive divergence leading into 2023. And that's something that we discussed. If you don't believe me, go back and you look. Okay, so that is interesting there. And then also S&P 500, we have a same situation as breadth is kind of deteriorating there, but yet the market remains still at that level. Copper took another big hit today, creating another low here. You know, it hit a pretty significant low in 2023 just right here. And then we just cracked a new 2023 low, which is not obviously good for the overall economy. We know this. We talk about Dr. Copper. I'm not gonna get too much into that now. The last chart I'll close off with here is the advanced decline for the New York Stock Exchange. This is the, you know, a broad market just like the composite, but you can see it held as support, it held as support, it held as support, and we've been tracking this to see if it breaks down. Well, today it got beneath it, so we'll see here if that holds now potentially as a level of resistance, indicating that, hey, this actually might come down potentially more. That's all I got for you on today's episode, everybody. Have a wonderful day.